Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to find the real story, and this Albertsons Companies Incorporated filing. Oh boy, it has got a few juicy bits. Let's just say things are getting interesting in retail land. Get ready for a deep dive into Albertsons' latest financial report to uncover what is really going on beyond the headlines. And by the way, if you find value in decoding these dense documents, make sure you subscribe and click that notification bell. We're also building a fantastic community over on Discord, so join us there. The link is in the description below. Alright, so this is Albertsons Companies Incorporated filing their quarterly report for the period ending the 29th of November 2025. Think of it as a progress report for investors, keeping everyone in the loop about how the company is doing financially. Let's jump straight into the numbers, starting with their balance sheet as of the 29th of November 2025 compared to the 22nd of February 2025. So what do we see here? Their total assets are around $27 billion, a slight increase from February. Their cash and cash equivalents decreased a bit from roughly $293 million to $195 million. That might seem like a lot, but it is often normal for retailers to manage their cash very tightly, especially around inventory needs. Speaking of inventory, their inventories actually went up from about $4.9 billion to nearly $5.5 billion. This suggests they might be stocking up for the upcoming holiday season, or perhaps anticipating increased sales. It is a big number, and managing that effectively is key for any grocery giant. Now, looking at liabilities, their total liabilities are substantial, but let's focus on the changes. Their current liabilities went up from about $7.2 billion to $7.8 billion, and a significant part of that looks like an increase in current maturities of long-term debt. This means a chunk of their long-term debt is coming due sooner rather than later. On the other side of the coin, their stockholders' equity experienced a notable drop from about $3.3 billion to around $2.5 billion. This isn't necessarily a red flag by itself, but it is something to watch, especially when coupled with share repurchases, which we will get to later. Moving on to the income statement, Albertsons brought in revenue of over $19 billion in the third quarter ending the 29th of November 2025. That is up from about $18.7 billion in the same period last year. That's a modest increase of about 1.9% year over year for the longer 40-week period. That is up from $61.5 billion to $62.9 billion, also a little over a 2% increase. So sales are growing, but at a pretty steady pace. Their identical sales excluding fuel were up 2.4% for the quarter, meaning their existing stores are performing a bit better. This is a good sign that their core business is healthy, but here is where things get a bit more nuanced. Their gross margin rate actually decreased slightly. This means the cost of what they sell is going up relative to their sales price. For the quarter, it dropped from 27.9% to 27.4%, and for the longer 40-week period, it decreased from 27.8% to 27.2%. They explain this is due to growth in pharmacy sales, which generally have lower profit margins than groceries, and increased delivery costs. As digital sales grow, this is a common challenge for retailers adopting new sales models. On the flip side, their selling and administrative expenses as a percentage of sales also decreased. This is good news. It means they are managing their overhead better. Even though overall sales are up, their costs to run the business are becoming more efficient. They cite several factors, including better sales, leveraging of employee costs, and lower merger related expenses. The termination of a major merger has clearly had an impact. Their tax situation is interesting. For the quarter, income tax expense jumped significantly from about $14.5 million to $84.4 million. This is largely due to a one-time tax benefit they received last year related to settling audits, which made this year's comparison look steeper. So while it looks like a big jump, it is important to understand the context. Now, the bottom line net income dropped from about $400 million last year to $293 million this quarter. For the longer 40-week period, it fell from $786 million to $698 million. This decrease is partly because of that one-time tax benefit last year, making the current year look less favorable. When comparing apples to apples, adjusted net income tells a slightly different story. It was actually up a bit for the quarter from $420 million to $390 million, with a slight increase per S-hair. So while reported net income looks down, the underlying profitability adjusted for one-off items appears to be holding steady or even improving slightly. Another key metric for business health, adjusted EBITDA, which is basically a measure of operating performance before certain expenses, also saw a dip for the quarter. It was $1.038 billion, down from $1.065 billion last year, and for the 40 Week period, it fell from $3.149 billion to $2.998 billion. This is happening even as sales are growing, which ties back to those margin pressures and increased investments in digital operations. Let's briefly touch on the statement of stockholders' equity. This is where we really see the impact of their share repurchase program in the 2025 period. We see a large increase in treasury stock, which is essentially shares the company buys back, and this is directly related to a massive accelerated share repurchase agreement. Worth $750 million, this program significantly reduces the number of outstanding shares, which can boost earnings per share, but it also means a large outflow of cash. Looking at their debt, Albertsons has been active refinancing and issuing new debt. For example, they issued new notes in March and November of 2025, totaling over $2.1 billion. This is a strategy to manage their interest costs and extend their debt maturities, which is generally a good move for financial stability. They also made a significant move with their pension plans by purchasing a group annuity policy. This helped reduce their pension obligations by about $295 million and resulted in a settlement gain. It is a smart way to de-risk their balance sheet. Now for the drama section, Albertsons is involved in some pretty significant legal battles. And these are not small potatoes. They're facing lawsuits related to the False Claims Act regarding how they reported prices to pharmacy benefit managers. And there is ongoing opioid litigation where they're named alongside many other companies, the False Claw. IMSAC cases have been through the Supreme Court and are heading back to lower courts for further review. These lawsuits are complex and could have financial implications, though the company states they have provisions for potential liabilities and are defending themselves vigorously. Remember that proposed merger with Kroger? Well, that is officially dead, the FTC, and the state of Washington put a stop to it. And now Albertsons has sued Kroger for breach of contract seeking damages. And that $600 million termination fee, this whole situation, has likely added significant legal costs and uncertainty for Albertsons. Economically, Albertsons operates in one major reportable segment, retail. They break down their sales by category non. Perishables are their biggest chunk, around 48%, followed by fresh foods at about 30%. Pharmacy is growing though, making up nearly 16% of sales. Fuel and other miscellaneous revenue make up the rest. Their strategy seems to be focused on digital growth, loyalty programs, and enhancing the customer value proposition with a tech first approach. Let's talk about that share buyback program again. So in the third quarter of 2025, they purchased over 38 million shares for about $650 million. This is part of a larger authorization that has been increased to $2.75 billion. They are clearly focused on returning value to shareholders through these repurchases. Looking at cash flow, their net cash provided by operating activities was about $1.6 billion for the first 40 weeks of fiscal 2025, down from $1.9 billion last year. This decrease is attributed to lower adjusted EBITDA and changes in working capital, but it is still a strong positive cash flow, meaning they are generating cash from their core operations. Investing activities show they spent about $1.4 billion on property equipment and intangibles for the first 40 weeks of 2025. These investments are in remodels, new stores, and technology upgrades, which aligns with their strategy to modernize and improve their operations. Financing activities reveal a significant outflow of cash. They used about $461 million in the first 40 weeks of 2025. This is largely due to share repurchases, dividends paid, and then some debt management actions. So what is the big story here? Albertsons is navigating a tough retail environment. They're growing sales and improving efficiency in some areas like SG&A expenses, but they're facing margin pressures from growing their pharmacy and digital businesses. The massive share repurchase program is designed to boost shareholder value, but it does drain cash. The ongoing legal battles, especially the fallout from the terminated Kroger merger and the older False Claims Act cases, are significant risk. To watch these could lead to unexpected costs and continue to create uncertainty. Albertsons appears to be executing a strategy of investing in digital and technology while trying to manage costs and improve margins. It is a balancing act, and the market will be watching closely to see if they can generate sustainable, profitable growth, especially with those legal clouds overhead. And the fact that they are returning so much cash to shareholders through buybacks is a positive for investors, but it also means less cash available for reinvestment or to weather unexpected storms. Alright, that is our breakdown of Albertsons Companies Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.